The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
I'm Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources podcast.
Well, there is a shift going on among investors and with both retail and professional investors. As a matter of fact, we are seeing a defined shift from fear of losing money because of a returning bear market to fear of missing out because the market just keeps going up and it doesn't seem to make any sense. Well,
right.
It depends upon who you talk to because both Bank of America this weekend raised its estimate for the year-end target on the S&P 500 by about 9%. Goldman Sachs also thinks that the market is fairly priced. And we have talked about, and we're not alone, talking about the extended prices of the Magnificent Seven stocks. They seem to be just rocketing up, and the fundamentals don't seem to make a lot of sense. When you have NVIDIA trading at 30 times earnings, and you say, well, how can that possibly be? Can business be that good, and how long will it extend? Now, there is a skeptic, Jamie Dimon, he keeps saying, I don't think this can last. But other professionals are throwing in the towel, and this conflict between the bigwigs on Wall Street actually attracted Fox Business to do a segment on it recently, saying which one of these guys is right. We all want to know.
Well, and we don't spend a lot of time at Investor Resources trying to figure that out. Who's right? We do know right now that there are far more dollars being voted into the market than out. So people are saying, you know what? We don't think this is a bubble either. We think this has some legs. We think we are in a bear market and it can continue. And so we're buying this market. And that's the way we feel about it right now. We've been saying for a while we were going to need a stimulus to come along before we can say we're going to get to new all-time highs and we're going to be in a sustainable market. And artificial intelligence may be providing that. It may be providing enough of a stimulus and a broad enough base of change across many, many different industries that this can run for a while. And there is a fairly large consensus that this is not a bubble and that we are not ahead of ourselves and that we're just in the initial stages of another significant growth period because of artificial intelligence changing the ground rules for many, many industries.
Well, the characteristics of the bubble are not the same this time around. If we go back and look at the tech bubble in the late 90s, that was generated by government mandate to upgrade all systems, all digital systems for Y2K. The fear was that DOS didn't have a provision, the DOS operating system didn't have a provision for the clock to roll over into the new millennia.
Yeah, but Don, you're saying that the government interfered in investment markets and caused a problem? Is that really true?
Yeah. That's pretty much what I'm saying.
You should have ended that with again. Yeah, again, they did it again, and yes, that they were the problem. Yes.
And as it turned out, if all you had to do was reset your clock to 5 minutes before midnight on Y2K, shut the computer off and restart it and see if it worked, and they did.
Everything was fine.
Here in my town, there was a major company, hardware store that ran its DOS operating system for inventory and cashiering for about 5 years before they upgraded their systems, and it still worked. But what happened was Congress or government forced businesses to compress the purchase of software and hardware that they did not need into a very tight time frame, which accelerated sales until 2000, when nobody needed to buy new hardware and software, and sales collapsed. And by 2001, reality set in, and we went into a bear market that did not end until 2003. Now, I will start this with, again, government got involved with the housing
Right.
bubble in 2005 and 6, and making
There you go.
mortgages readily available, failing to do quality control on the processing of paper. And they created the flip business in real estate, and then housing collapsed. So this time around, what looks like a bubble is actually being generated by businesses figuring out how to be more profitable, how to generate more product and services that were never before economical. So the artificial intelligence isn't just semiconductor related. It's not just
Correct.
NVIDIA. It's not just Intel or AMD. This is affecting virtually every industry. I saw an article from a financial advisor, and he said, with software, we just fired 2 people. We don't need them anymore. He said a high school kid can be trained to run this program to do what we need to do for our clients.
Correct.
That's a big impact on services in financial services industry. The proposition has been laid out for discussion. Will anybody ever need a financial advisor again? Well,
I've heard that. Yeah.
the bottom line is artificial intelligence doesn't think, it processes, and it can process more efficiently. So you take basic legal documents, and attorneys can get them done much more rapidly. And in some cases, on simple stuff, you can. Online, you can get your own legal documents done with a high degree of reliability. But in many cases, you still need somebody to have a discussion, to review what you've done, to review the inputs, to be sure there wasn't
Sure.
an error, because it's still a garbage in,
Legally,
garbage out business.
AI can sift through a massive amount of data, unbelievable amount of in legal in the legal circles, in contract law especially. They go back decades and go through every contract that was ever even similar to what you're looking at, and they will say this is a good way of doing it and this is a bad way of doing it, but you still need somebody at the end to be able to say, and this is what we're going to do this time. You need somebody there to make that decision. At this point, it's not autonomous. It does need to be run, and it is just doing what it's asked to do. Even the new the generative stuff where they're producing text or they're producing graphics or they're writing code themselves, someone has to tell them what to be writing. So there's still got to be humans involved right now. So, but like you said, Don, sometimes fewer than there were. So that can be that's how productivity is going to continue to be driven up. That increases profit margins. That makes companies more valuable. That means people are willing to pay a higher premium to buy a piece of ownership, to buy a stock in a company, because the profit margins are higher and they're going to be more permanent. The profit margins are going to be, it's not like they're on the edge and they're about to give it all back up. They're going to get wider and wider for a while because that productivity is going to continue to increase. We're going to get better and better and better at applying artificial intelligence to more and more situations, and the outcome is going to be profitable.
Well, you mentioned profits. This last quarter's earnings season just came to an end, and just slightly more than 3/4 of the companies in the S&P 500 had better than expected earnings reports or forecasts.
Yeah,
And the reason the Bank of America raised their year-end assumption for the S&P is because they expect that improvement in earnings is going to continue to compound. So
there you
as an
go.
investor, if you've been sitting on the sidelines or just kind of sticking your toe in for fear of taking big losses, particularly if you've been around for the last 30 years, you've been through some nasty bear markets. They've been very, very uncomfortable. And
Sure.
that hindsight bias is skewing people's perspective of the major transition that's going on in the market right now. Earnings are going to improve as businesses figure out how to adapt artificial intelligence into basic operations. Managing staff will be one of them, but managing product and retail sales. One of the stores that's actually right at the front end of this is Whole Foods. Amazon owns Whole Foods, and they are introducing more stores that are walk in, walk out. Every product has an RFID code on it. You walk out, you walk in, put what you want in your basket, and you walk out. It's automatically charged to your card. They don't need anybody at the check register. And if you, now I don't know how they're going to handle theft issue on the on those people that
Right,
run in
right.
with no credit card, but they're just cleaning up the shelves. However, at Whole Foods, they aren't selling Apple iPhones, which are an
True.
attractive black market product.
It's true. It's true.
But
But
but that's
all
one,
it's
that's
going
an
to continue.
example of the extension that can be manufactured by direct application.
And there's going to be places, don't be put off by the fact that there's going to be places where it doesn't work out quite as well, quite as fast. You're going to see people that are going to say AI doesn't work for us, and we don't think it's here to stay, and it's not going to be in every case. And we are right at the beginning of really broad applications. So there are going to be places where it doesn't work, and there's going to be places where it stubs its toe. That's just new technology getting going. It doesn't mean that there are big problems with the industry. There's probably not. I just read earlier today, NVIDIA just bought 5 new AI companies themselves. They're obviously flush with cash. They can't innovate fast enough. So they're just buying other companies. They're not buying those companies because they think AI is about to dry up. They know that it's going to happen so fast. They have to leverage their current position by just buying other companies instead of trying to get up to speed in what those other companies are already doing. So there's a lot coming. And there's going to be a lot more coming, and the applications are going to be broader than we think, and they're not all going to work. Everything's not going to be wine and roses if you open AI, just like it wasn't when the internet came around and everybody said all you need is a good URL. You get the right .com, you're set for life. Turned out not even close to true. And AI is going to be the same way. It's not going to fix every problem. It's not going to enhance every business, but it's going to do a great job in so many places that it's really going to be affecting the business environment worldwide.
So there are many different companies to buy if you're investing on your own, and one of the way to diversify that is to buy an exchange traded fund. There are
Oh yeah,
multiple choices among exchange traded funds that will give you diversification. And those funds, with the excitement that's building, they're not as exponentially on a day-to-day basis as Nvidia by itself, but they are growing much faster than the market as a whole and the market
sure,
historically. But this is an area where you still need to pay attention. Even if you buy NVIDIA, NVIDIA has won on the investment arena because it has tolerated some very, very substantial drawdowns where
sure.
we've had clients who have owned it before joining us who ask constantly, anytime it's dropping in value, is it time to get out? Should I get rid of
Should
it?
I dump
And
this?
they never
Yeah,
sell. But if you have to take a 40 or 50 or 60% temporary loss over a period of many, many months, do you have the stomach for that? And if you're buying something that is at its peak right now, you need to understand what you're doing. And momentum may carry it further up, given the
right.
current environment and the demand for the product. But it doesn't mean that buying at the top is exempt from drawdown risk, which
Correct.
from an accelerated high can be very painful, which is why an exchange traded fund with diversification in the company exposure may be a better way for many people to put their portfolio to work in the semiconductor arena. It reminds me a bit of biotech. I mean, biotech and healthcare are going to
Sure.
benefit from AI, but biotech companies, for the most part, are not profitable. They're all working on some new cure for a disease that most of us have never heard of, and hoping
Right.
that they can make enough progress that a bigger company will buy them out. So it it comes with significant risk of at least short-term losses.
Correct.
And semiconductor business today is the same thing because there's a lot of excitement going on, and people aren't necessarily making rational investments. They're making emotional ones. And if you're making an emotional decision, it means that you don't have a process for your portfolio. And if you want a winning portfolio, you must have process. Why are you buying this? Why are you holding it? And what are you going to do if your assumptions were wrong? and it goes against you. All of that's basic process for building a portfolio and a successful investment platform. That's what we do at Investor Resources. We build portfolios. We always have an answer to those questions. We're asking them all the time, and we always have an answer. Why did we buy it? Why do we hold it? And what will it take for us to change our mind? Sometimes, and more often than you like perhaps, all of your best assumptions don't work out quickly. And then instead of being married to your emotional decision, you need to say, this one didn't work. It's just part of being in the business. It's part of being an investor. Get rid of your losers quickly. Hang on to your winners. That is what builds a successful portfolio. It's not just diversification. It's diversification into the right stuff, into things
And you have to have
that
that process. It's got to be in place prior to those questions coming up. You can't decide in the midst of turmoil what you should be doing. You need to have those processes in place. So when things get off the track, you know whether it's time to cut the losses and leave, or let it ride and see if it won't correct itself. Processes will get you through. That's why we're process-based investment advisors.
if you want to know about our current position and our portfolios, the link to our website follows on this next slide. Use that link to get there and watch our most recent webinar where we touched on current market conditions and we explained some of our positions in our portfolio and why they're there. Subscribe to our podcast and we'll keep you updated on what we're doing. Have a great day.